Welcome to the presentation of the results of the German Debt Project 2024. We are presenting today the results of the commercial real estate debt market in Germany that we are analyzed with the help of a survey of the leading commercial real estate lending institutions, i.e. banks. So who's we? That is Simon Wiersma, who has been analyzing with me together the market, and myself, Tobias Just. I'm the academic director of the IREBS Real Estate Academy. Thanks to our sponsors, to Wolfing Gesa, FC Europe, Inreal, MSCI, and the CIA. Thanks also to a kind support with data and intellectual input from VDP, Verband Deutscher Pfandbriefbanken. The methodology has been unchanged for the last 10 years, so we are analyzing data that is directly prepared by the banks and is feeding into a portfolio analysis, and we are leading approximately 20 interviews with the capital market analysts, all with the board members, all with the department heads for commercial real estate lending. So it's a mix of quantitative and qualitative analysis that I will be presenting. The next slide, you will see the participating banks. So all of them have been interviewed, and only the banks on the left have also prepared data that we can analyze in our surveys. Before we start, the main results. The macroeconomics in Germany is still weak. We expect a recession to be happening in 2024. So we are not yet in the growth momentum. Only for next year, low growth might be expected. The real estate finance market is mirroring that, but in different ways than in the past. The real estate markets are hit hard by the increased interest rates over the last years. And now the lower interest rates are a little help, but it is not yet back to growth. But what we see is a growing differentiation in the markets. So the banks are active, but not everywhere. They are active, for example, in residential, in logistics. They are less active in office. But differentiation goes further. They are active in some office segments, they are active in some retail segments, and they're active in some logistics segments. So the differentiation is not only by asset classes, it's also within the asset classes, it is within the regions, and it is who gets how much of the capital. Third back, we are going into different burdens. So we have significantly burdened segments. That is not the usual suspect of corona pandemics. It's not only the retail and the hotel industry, but increasingly also some segments within the office market. The banks are still remaining careful. They are regulated tightly and need to be careful by who to give the money. What is seen throughout the survey, the sustainability question has been shifted towards the top board and management decision-making process within the finance. That means all three aspects, environmental, social, and government aspects, are covered today in financial aspects, but environmental aspects are by far leading. So let's go into the separate aspects in more detail. First, competition is back. So we are asking the banks, how do you see competition in this half year compared to the half year before? So everything that is red here means in these periods, the banks have been reported that competition has become fiercer. So throughout the years until the corona pandemic, competition has increased. The pandemic has led to lower competition because banks have been very careful in the beginning, but you see it has been only lasting literally 2 quarters. After that, competition was back until the ECB increased interest rates, and then there was a shock momentum and competition eased significantly. Banks have been very reluctant directly after the interest rate hikes. But at the very current end, in 2024, it seems that competition is back, but not everywhere. Banks report that there are some segments where competition is increasingly fierce, almost back to the pre-interest rate level, and that is the pockets that we could call core plus, core, super core. So all that where location is important, or there where the offices or the retail space is fully let, or where we have a long contract. But the banks are reporting that the environmental aspects increasingly also play a role. In other segments, competition is still weak. So this is part of this differentiation that we are mentioning. What is the overall market? The overall market has been declining in 2023 by a significant double-digit amount. So the overall new business of the banks has been declining by more than 30%. And this is a second year in a row that market business has been decreasing. The overall loan book has been shrinking only weekly, and this is simply due to prolongation that is, of course, playing a major role for all those who are doing development, investment, and the banks also have an interest to do the prolongations. So until now, the loan book is not decreasing rapidly, only immediately, but the new business has been declining sharply. As I mentioned before, we see a significant ongoing differentiation between the asset classes. So the banks are very happy to finance residential, a little less happy to finance logistics than in the previous years. That means banks are looking more carefully. Some have been talking about a logistics hype, and they are looking at it more carefully. Some have been raising the point that we have to look at e-commerce logistics and industrialization logistics, that means for manufacturing products, differently. So of course, everything that is dealing with manufacturing is hit hard by the weaker economy. Everything that is dealing with e-commerce logistics is still benefiting from a structural change towards more e-commerce. What we also see that hotel is somewhat back. So after the pandemic, banks were very reluctant with financing hotels, and mainly only doing a few deals, and actually partly also family hotels and holiday hotels. But now the focus is clearly that they're going back, they would like to do more in hotel, and that they are focusing again a little bit more on business hotels. With regards to office, only few transactions are be seen, and this is primarily the core location, the best locations, new offices, very efficient, and also sustainable offices. Maybe to some surprise, not only supermarkets and big box retailing has been financed, but some banks are moving slowly back to the hard-hit other retail segments. That is, for example, shopping centers. But of course, after they were repriced significantly, and they are doing it very carefully and they're very prudently. This focus, as I mentioned, is going deeper. When they are looking at offices, they are only looking at central offices. They are not looking at peripheral offices. When they are looking at retail, they are not looking at any retail, but only these mentioned segments. So this differentiation between the different asset classes is aggravated by differentiation within the asset classes. What is more, banks have been very active managing their portfolio. What you see here is that the term structure of their different loans. What we currently see is that there is a peak at the very short end, and the peak at the very long end. And that is mirroring this activity. So some loans have been pushed to a very long termination end, and some loans have been dealt with only a very short term. But many investors, and particularly developers, had to fight, what am I going to do with my credit, with my debt? And they are asking for prolongation. And most of the developers are asking for short-term prolongation because they hope they finish their project, they hope that they will then be able to sell it. So this is the sharp increase at the short-term end. But some investors, some long-term investors would rather have to have a better planning, and therefore they shift to the long end. So therefore this V that we currently see is more pronounced than in the previous years. What we also see that the internationalization, as it hasn't been as strong as before the great financial crisis, there is no echo effect as strong as after the great financial crisis. That means banks keep their strategy before the interest rate hikes, and they can keep to it after the interest rate hike. Within this set of countries, it was remarkable that very often countries were highlighted, not only the usual suspect like US, UK, and France, but we heard more often than in the past Italy and Poland. And particularly Italy was a little bit surprising because that was hardly mentioned in the past. But some banks are